Okay, so the pending credit crisis that I've been warning you about now for a few months is here. Actually, that's kind of a misstatement. It's been here. Now it's accelerating. And if you don't think this affects you, you're wrong. Let's talk about it.
I got a bad feeling about this.
Okay, so remember a few months ago when we had that spate of very public bank failures out in California, namely Silicon Valley Bank and Signature Bank and First Republic Bank. And remember, we also had Credit Suisse over in Europe that went out of business, which I also predicted. Well, in the throes of that big event, I told you that it's not over, that you're going to be seeing more of this. And I also told you that one of the consequences of these events is you're going to see the entire financial industry start to pull in their credit lines. So this credit reduction phenomenon is going to cover all facets of the credit industry, from credit cards to personal lines of credit, to builders out there who use lines of credit, to mortgages, to car loans. They're all going to be cut back. Why? Because people are pulling their money out of the bank. Have you been, by the way? If you haven't, get on that. Remember, the banks don't keep any reserves. So as people pull money out, these banks have to sell assets in order to honor these withdrawal requests. And what are they selling? They're selling these really junky U.S. Treasury bills, which they've had on their books. And as banks see all this money fleeing their banks, people taking money out of their accounts and putting them into like money market accounts or doing things like buying gold and silver, which you should be doing, these banks have less money to give out. Now, again, if you think this issue doesn't affect you, let me tell you a story. So yesterday, a furniture company named Clausen announced that they're going out of business. Why? Because their credit limits at their banks have been cut dramatically. Now, we live in an economic system that rewards debt, right? We are a very debt-based society. That's true for Western countries in general, right? We are debt-based societies. And our tax code incentivizes companies to take on debt. I won't go into all the fancy stuff here, but just know for the purposes of this report, the IRS code favors companies who take on debt. And so our companies in the West, they operate on kind of a very precarious, system. They maximize their debt, and then they've got to service that debt, right? And as interest rates go up, the cost of servicing that debt also goes up. But they need those credit lines in order to pay their vendors and to pay all their bills and to make payroll. Well, for companies like Clausen, which is a furniture company, they operate on very thin margins, right? So they're always dancing on the head of a razor. So when the banks cut their credit limits, they can't manage that. So the house of cards comes crashing down. And in the case of Clausen, about 4,000 people are going to lose their jobs. So for those 4,000 people, this credit crunch issue in the financial system becomes very real. Even if they don't understand it, that's why they're losing their jobs. And this has been going on now for a few months, this phenomenon. And I promise you, this is going to get a lot worse. As we head into the fall, we're going to see more bank failures. We're going to see more contraction of the debt system. This is a very real issue. And for the fun of it, let's take a snapshot view at what the stock market is doing today. So as I'm recording this, it's late in the morning, and the market is already down 352 points. But let's take a close-up view. This is the 3-month chart. Let's take a close-up view. Let's take a look at the 1-month chart. All right. Now, if you look at the past 1, 2, 3, 4, 5 trading days, this might not look like very much, but these are actually very big moves. So we started out with a very big move to the downside, and then it stayed steady the next day. The next day, it tried to rally, gave it all back. Yesterday, we actually had a pretty big day percentage-wise, but it got right to the high of the previous day and could not go any further. And now today, so this is the current line in the sand here, 35,000. For this market to have its next move to the upside, it's got to take out this 35,600 or so. Around 35,600 is what the market has to do. I'm talking about the Dow Jones Industrial Average, right? Now, the market has been going up in here. So with all this bad economic news, why has the market had a nice little rally the past couple months? Okay, so this is where the stock market becomes weird. Right? This is where the stock market kind of dips its toe into a bizarro world, okay, where things go up for all the wrong reasons. And this is where contradiction in terms come into play, like where bad news is good news and good news is bad news. Now, part of the reason why the market had a little bit of a bump the past couple of months was because the government came out with inflation news that they say that inflation was holding even. But we all know that is only because the government manipulates the number. It's a rigged number. To a large degree, the government has its thumb on the scale of the markets. And the Federal Reserve and the Treasury Department, they play a big role in influencing the market. And it's always been that way. But at some point, their games won't work anymore. And the markets will float to where it really should be. And that's when you see big events happen in the market. So as we go into the fall here, I want you to be very careful about, being exposed to the stock market or the bond market. We have the potential here for a real shock to the system. And there are a number of landmines, any one of which could trigger a nasty sell-off, including, don't forget, the derivatives market. It's been a while since we talked about the derivatives market. The same market that caused a sell-off in 2008 to 2010, that issue has not been fixed. In fact, it is worse today. Remember, $1 quadrillion of exposure to the derivatives market. Well, look, 1 or 2 bad days in that industry, and you could see bedlam. The point being, have a plan. Okay, don't just go through life thinking that everything's going to be okay. You don't have to pay attention. You do need to pay attention. I mean, you don't have to, center your life around all of this stuff, but come up with a plan. Put some stops in place. So the point of this video today is to remind you of this credit crunch that I've been warning you about. It has been underway and it is starting to accelerate, meaning banks are starting to contract the credit lines that they're giving out at a more dramatic pace. We're going to see many more bank failures coming up imminently, so start watching for those. Get your money out of the bank, put a bunch of your money into gold and silver, and establish streams of passive recurring income. So that's my report for today. Live from Minnesota, I'm Ed Anderson.